A company does not lose 21% of its value in one trading session unless something fundamental has broken, or the market is telling you something about the entire sector before the headlines catch up. ON Semiconductor just had one of the worst single-day performances of any large-cap chip stock in 2026. The question that actually matters is not why it fell today. It is whether the business that existed yesterday is structurally different from the one that exists right now. And what the answer to that tells you about every semiconductor position you hold. Let's be precise about what happened, because vague explanations are useless when you're trying to develop a real analytical framework. ON Semiconductor reported quarterly results that came in below Wall Street consensus on both revenue and forward guidance. That alone rarely produces a 21% single-session move in a company with a market cap of this size. What turns a bad quarter into a genuine crash is when the guidance cut signals that the problem is not temporary. It's cyclical and structural at the same time. ON's revenue decline was concentrated in two segments: automotive and industrial. These are not peripheral businesses for the company. Automotive and industrial together represent well over 80% of ON's total revenue. When management guided forward, revenue lower by a margin that exceeded analyst estimates by roughly double the typical miss range, the market repriced the entire earnings trajectory, not just the next quarter. The specific mechanism here is inventory destocking. The customers who buy ON's chips, automakers, industrial equipment manufacturers, energy infrastructure companies, built up excess inventory during the supply chain crisis years and are now burning through it before placing new orders. This means ON is seeing reduced demand, not because end markets have collapsed, but because the channel is digesting a backlog. The catch is that nobody on the outside knows precisely how deep that inventory overhang is, or how many more quarters it will persist. When the duration of a cyclical headwind is genuinely uncertain, the market tends to discount aggressively. That is the rational explanation for the severity of the move. The actionable insight here: when a semiconductor company's two largest segments both guide lower simultaneously, the question to ask is not how far the stock has fallen. It's how long the inventory correction has left to run. This is the question that separates disciplined investors from reactive ones. And the honest answer is, it's complicated in a specific way worth understanding. ON Semiconductor is not a company with a broken business model. It holds a genuinely differentiated position in silicon carbide power semiconductors, the technology that sits at the heart of EV drivetrains and fast-charging infrastructure. SiC is not a commodity. ON's elite SiC platform competes directly with Wolfspeed and STMicroelectronics for design, wins with major automakers. And design wins in semiconductors are sticky. They don't evaporate in a single quarter. Here's where the market's reaction requires some decomposition. The 21% drop prices in a scenario where the EV adoption curve materially disappoints and the industrial recovery timeline extends well into 2027 or beyond. That is a plausible scenario, not a certain one. EV penetration globally was approximately 18% of new vehicle sales in 2025, and forecasts for 2026 range widely depending on region and policy environment. If EV adoption continues on even a moderate growth path, ON's addressable market expands materially over a 3 to 5 year horizon. What the market is correctly penalizing is near-term earnings power, which is real and significant. A company that guides revenue 10-15% below prior expectations needs to see that reflected in its multiple. The debate is whether a 21% haircut is the right magnitude. Historically, semiconductor stocks during inventory correction cycles tend to trough approximately 2 to 3 quarters before the actual inventory normalization is confirmed in reported results. The market moves first. That pattern is not a guarantee. It's a base rate worth knowing. And here, because this needs to be said clearly, none of this is financial advice. Whether on is a buy at this price depends entirely on your time horizon, risk tolerance, and portfolio construction. Factors only you can evaluate. What we can do is give you the analytical framework the market is actually using. Moments like this are more valuable for your long-term development as an investor than 50 hours of coursework, because they are real and they have consequences. The first lesson is about the difference between a business and a stock. On Semiconductor's silicon carbide, technology did not become less valuable today. Its engineers did not lose their expertise. Its design wins with automakers did not disappear. What changed is the near-term earnings trajectory and the market's patience for waiting out the cycle. Understanding that distinction prevents you from making two opposite mistakes: panic selling a fundamentally sound business or buying a deteriorating one because the price looks lower. The second lesson is about the role of guidance in semiconductor valuations. This sector trades on forward expectations more aggressively than almost any other. A chip company's stock price is essentially a discounted cash flow model, running in real time on every trading terminal in the world. When management updates the inputs with a guidance cut, every model in the market reprices simultaneously. The speed and severity of the move is not irrational. It's the natural output of a market where information is processed extremely quickly. The third lesson is about sector-level contagion. When ON fell 21%, watch what happens to adjacent names: Wolfspeed, ST Microelectronics, Allegro Microsystems, ON Semi's competitors and suppliers. A move this large in a sector bellwether often precedes broader repricing across the value chain. That's not guaranteed, but tracking the ripple effect gives you signal about whether the market views this as company-specific or industry-wide. The broader principle: single-day crashes in established companies with real technology and real customers are almost never the end of the story. They are a chapter break. Your job as an investor is to determine whether the next chapter is a recovery or a prolonged decline, and to have the analytical tools to distinguish between them before the price makes it obvious. The investors who build real wealth over time are the ones who do that work, while everyone else is reacting emotionally to a red number on a screen. We opened by asking whether Owen's business is fundamentally different today than it was yesterday. The answer: the technology is intact, the design wins are intact, and the cycle will eventually turn. What changed is the timeline the market is willing to price. That open question, when does the inventory correction end, is exactly what we'll be watching in the next earnings cycle. Speaking of questions that don't have easy answers yet, next video, we're going deeper on the silicon carbide supply chain and who actually wins when EV demand recovers. Subscribe so you don't miss it.